Dollar cost averaging, DCA, is a straightforward yet effective investment strategy that helps manage risk by regularly investing a fixed amount of money, regardless of an asset's current price. Rather than trying to time the market, DCA focuses on consistency. You invest the same amount at regular intervals, whether prices are high or low. This strategy enables you to buy more shares when prices are low and fewer shares when they're high, ultimately reducing your average cost per share over time. As a result, DCA provides a buffer against market fluctuations, making your investment less sensitive to short-term price changes. To illustrate, imagine you're buying your favorite snack each week. Some weeks, the snack is on sale, other weeks, it's more expensive. By the end of the month, the price you paid has averaged out. DCA works similarly by smoothing out the cost of your investments over time. This approach removes the emotional element of investing, helping you avoid the common traps of panic selling in downturns or buying excessively during market highs. In the long run, dollar cost averaging can lead to more stable returns and make your investment journey less turbulent. It encourages disciplined investing and provides a structured way to build wealth steadily, helping you stay focused on your goals rather than reacting to market ups and downs.